Good afternoon. My name is Emily Lee. I'm the new director of AIIFL, the Asian Institute of International Financial Law based at Hong Kong U. It gives me great pleasure to introduce today's distinguished speaker, Professor Mark Findlay, and his research associate, Ms. Nydia Remolina. Today marks the beginning of the official launch of a special series of publics with thematic focuses on data governance, data protection, and the ethical use of AI. In fact, I'm working with two regulatory authorities in Hong Kong, the Hong Kong Monetary Authority and the Privacy Commissioner's Office in order to extend the theories. But I'm just so grateful to you, Professor Findlay, to lead the special series of public lecture. I'd like to take the time to introduce first Professor Mark Findlay. He's a professor of law at Singapore Management University and director of its Center for AI and Data Governance, where he's a professoriate research fellow. In addition, he has honorary chairs at the Australian National University, the University of Edinburgh, and University of New South Wales. He also is an honorary senior research fellow at the British Institute for International Comparative Law. He's extremely productive, having written and published 29 monographs and collections and over 150 refereed articles and book chapters. Personally, I have great respect for Professor Findlay because he has a reputation of being a great mentor to junior colleagues, extremely supportive. And when I had the pleasure and opportunity to do my presentation at SMU back in 2017, his constructive comments were not just insightful, but extremely helpful for me to improve on the quality of my research paper. The other speaker today is Nydia Remolina. She is a research associate at SMU Center for AI and Data Governance, an adjunct faculty at SMU. She is also a member of the Swiss FinTech Innovation Lab at the University of Zurich and a member of the advisory board of the Center for Artificial Intelligence, Law and Society at GOA University in India. She has also acted as a senior advisor to the OECD, has a master in science of law from Stanford University, and has graduate studies in economics, finance, and computer science. And she is a PhD candidate in law at the University of Zurich. Without further ado, the floor is yours, Professor Findlay. Thank you.
Thank you very much, Emily, and thank you for the warm introduction. I appreciate the opportunity to share the opening of this series that you're organizing, and I wish it well. We have had the opportunity to discuss concepts of AI governance in many different parts of Asia and around the world quite recently, largely because the discussion of governance has become something which all sectors of AI application and the use of big data are concerned about. The concerns range from simple issues that relate to how do we make sure that data is fairly and adequately and accurately employed, right through to quite complicated questions of science and technology. Today, what we're going to do is focus primarily on AI governance issues in relation to the financial sector, and the lecture will be divided into two parts. I will introduce the broad thinking about AI governance and what we call in our center AI and community, and then touch very briefly on digital self-determination, which is a new but exciting concept in the realm of data governance. And then Nydia will take us directly to her area of research excellence, that is data-driven finance challenges, open finance and fair lending. And she will explore some of the research that she's been doing and relate this back to the climate as it's emerging in Hong Kong. The first slide. AI and data governance. We take what we call a contextual approach to the question of data governance. We're looking for a holistic and interpretative understanding of governing AI and big data. Now, AI and big data break down into two separate governance realms. AI governance looks at ethical ramifications of AI. This is in terms of products and solutions. Inclusive design, the way in which the recipients can be brought into the design world, and issues within AI teams, the ecosystem. And then data governance, which is perhaps more directly related to the financial sector. Data protection and privacy is the conventional way of examining this area. Data quality, which has become a big issue, certainly in China and those areas that are engaged in mass data sharing. Power dynamics between data subjects and data collectors. And this is digital self-determination, which we'll touch upon in a minute. Next slide. What is AI and data governance as research? How do we research AI and data governance? And this is something that we've been examining in our centre for some time. The first point is something that Emily raised a little bit earlier with us, and that is the whole interdisciplinary field of study, which looks at risks and challenges in the use of algorithms and data in decision-making processes. This asks for a consideration of law, consideration of finance, business, organizational studies, data science, philosophy, a whole range of different disciplines that we need to explore. The aims and assumptions of this research is to propose ways to address challenges, to promote responsible and ethical use of technology, and then implementing an accountable and trusted ecosystem where we find that both the private and public interests are at heart. The outcomes of this research: governance working at different levels, governance providing accountability and transparency through monitoring systems in practice. This is something which is obviously very much in the forefront of the mind of those in the financial sector, and governance identifying and ensuring clear roles of decision-making. Next slide. The governance of the AI ecosystem. The AI ecosystem is really, in my mind, something which moves from one part from the design and the development of an AI concept through to its deployment. And all the way along that line, there are decision sites that need to be examined. Those decision sites involve things like governance through and across data science, technology development, user practice. And governance in this situation, in an ecosystem sense, requires the recognition of risk, actual and perceived, and that's important to understand. Many of the risks which stand in the way of effective deployment of AI systems in communities are based on fears that may not necessarily be substantive, but are perceived. And then strategies to address legitimate needs and aspirations of stakeholders. Next slide. Digital self-determination. This takes us somewhere beyond just the standard discussions of privacy, the standard discussions of data protection, and more to a question of the creation of a respectful data space, digital space, in which the integrity of personal data can be understood, identified, and protected. So we're looking for the necessity of empowering data subjects to be able to oversee their sense of self-esteem in the digital sphere. This means that data subjects become the focus of the process. And when you look at this in the financial sector setting, obviously we're talking about customers and clients, but we're talking about a large community of users of financial services who should be considered at the heart of any data access and data management program. And we're looking for the actual ability to govern our data, transactability, and situations where public preferences are merged with a consideration of self-interest and communal responsibility. So translating digital self-determination into practice, how does it work? Well, it's an exercise in trying to find a balance between individual and collective sentiments. It's developing ways in which data designated as essential for digital self-determination can be given primacy for social good. And then it asks questions about how commercial, political, and economic interests committed to concepts such as data sovereignty, data trade, data commodification, and data rights could be encouraged to realize the benefits of maintaining sustainable access in safe digital spaces. And so this introduces considerations of questions like open finance, the way in which open finance should operate, and algorithmic credit scoring, which I think Nydia will take you to in much more detail.
Thank you so much, Mark. So as Mark was mentioning before, the concept of digital self-determination links to some of the most important issues that currently regulators, policymakers, and the industry, the financial services industry, is discussing right now in the context of open finance and algorithmic credit scoring. Why are we going to talk about these two use cases? Because open finance talks about the importance of having access to data to develop technology implementations based on that data. So basically data-driven finance applications. And one of the most common ones and one of the most interesting for the financial services industry, and not only for incumbents, but also for fintech companies, is the development of algorithmic credit scoring applications. And based on that, we wanted to link this the issues related to digital self-determination in these two contexts to just contribute to the debate that, as I mentioned, policymakers and the industry are having right now. First, what we are referring to when we mention the concept of open finance. Open finance started to be named as open banking, but now this data access type of initiative is broader than something applicable to the banking sector. It is applicable to any type of financial services sub-industry, let's call it that way. And what does it mean in practice? Basically, it means that someone that holds the database or controls the data from financial consumers, or the data produced by data subjects, is let's say a financial institution. The financial institution is willing or is obliged, depending on the regulatory model, to open the access to this data for third parties. These third parties connect to the database or the financial institution through something called API, or application programming interfaces. Through the application programming interfaces, the third parties are able to develop new use cases based on that data that was controlled initially by a financial institution. At the end of the day, the end user or the data subject or other financial consumers are able to access products and services developed by those developers or third-party service providers. Why? Because they were able to access the data that was controlled initially by the incumbent or the financial institution. In the other side of the chain, so namely the third-party service provider or the developer, is not necessarily always a fintech company. We are seeing now implementations of open finance and applications in this context that connects, for example, two incumbents or two traditional financial institutions. But when in the beginning, when open finance and these data access type of initiatives were born specifically were created in the United Kingdom and the European Union, one of the purpose behind this was to encourage and enhance competition. So the third-party developer was expected to be a non-traditional financial service provider, or a fintech company, or a technology company. This is a concept that is not new from the financial services industry. data access type of interaction between two parties. It's something that it's been used for years in, for example, social media. Facebook has this website called Facebook for Developers, in which Facebook basically offers open application for programming interfaces to anyone that acts as a developer or third-party service provider that wants to connect with Facebook through an API in order to have access to the data that Facebook controls from the data subjects that open profiles on this social media platform. Another example is Yelp. Yelp is a very famous application. Probably some of you have used it before, in which you can just search for a restaurant and provide reviews based on your experience in that restaurant. And Yelp shows basically in the application, in the app on the mobile phone or on the website, it shows the exact localization of the restaurant. So you are able to see on the map of the city where the restaurant is located and how to get there. How do they provide this service to their clients or the users of the app? Because they connect with Google Maps through an open API, and they are able to show a Google map on Yelp app. Without the world of application programming interfaces and the use of them, Yelp, for example, would have been obliged to develop a map from scratch instead of using the one and leveraging on Google Maps that already developed this type of geolocalization application. So that's just one example. And in the financial services industry, we will see that many services are being developed because these third-party service providers are connected through open APIs to the incumbents or other databases that hold data that is from financial consumers or were collected initially from financial consumers. Some promises and challenges of open finance around the world. It is supposed to enhance or promote competition in financial markets, because if more third-party developers have more access to data, they will be able to develop new types of products and services for financial consumers and promote competition in some jurisdictions. As I mentioned, this is the case of the European Union and the United Kingdom, motive behind the open finance or open banking initiatives that started since 2013 with actually an antitrust investigation in the United Kingdom. To facilitate innovation, that's another thing. Sometimes the traditional financial service providers are not interested, or it's not as easy for them to innovate and provide new types of products and services, and products and services that are based on financial data or other type of data. So these third-party service providers can increase innovation in certain jurisdictions to enhance user experience or customer experience, because the new generations, for example, Gen Zers, are more interested in working with wearables or new type of products and services that look for them more friendly than the traditional financial services provided by traditional financial institutions. That's the case of some investment apps, for example, that some regulators are looking into right now, and how friendly they should be. That's another debate, but it's like we are seeing these increasing numbers of applications that make investment more friendly and actually kind of mimic investment decisions to just playing a game. So those are examples of what users are demanding right now in financial markets, and these non-traditional competitors can bring that to the table in terms of user experience. With more access to data, that is certainly an opportunity for these non-traditional players in the ecosystem. To promote financial inclusion in some jurisdictions, traditional financial institutions or incumbents are not able to offer their financial services in all the territory of a specific jurisdiction. So the non-traditional players, and particularly those that offer services only through online means, are able to offer this type of services more easily if they have more access to data. To enhance AI capabilities and data openness is something good because it kind of links this promise with the previous ones that I just mentioned. Challenges, obviously some challenges, and this is probably the most interesting part for academics and some of us that are trying to contribute to the debate on access to finance, open finance, and access to data. Those challenges are very important to address and to do research on and to promote good practices in order to solve them. Consumer protection, because of the third parties are not always regulated, are not always licensed in all jurisdictions, so it would change depending on the country, on the specific country that we're talking about. Competition issues, because of the platformification of financial services, is another thing. This could be this enhanced access to data in financial services could be the beginning of the entrance and the the takeover of big tech companies in financial services, according to some scholars. So this is something, this evolution is something that we need to address, and we need to keep monitoring while we implement open finance initiatives. Data privacy issues, because obviously we have more people having access, more companies having access to the data. So this calls back to what Marcus just mentioned in digital self-determination and the importance of empowering data subjects. Beyond talking about data ownership and who has the legal right to develop or to earn something economically out of the use of the data, but something that is more related to what are the rights and duties that all the parties in the ecosystem have, and how that links to the importance of empowering data subjects in this new context of enhancing access to data. Data governance, related to what I just mentioned, and data privacy. Cybersecurity, because of the different standards of traditional financial institutions, probably they are subject to different standards than these new players in the ecosystem that will connect with them through open APIs. That will depend obviously on the jurisdiction and the specifics on each regulatory framework. Externalities in an enhanced AI ecosystem, because more access to data will increase the implementation and the deployment of AI use cases. So we need to see the consequences, especially the unintended consequences of the use of artificial intelligence in certain contexts in the financial services industry. And this links to the use case of AI in relation to fair lending, which we will talk about in a minute. What are the different regulatory models in open finance around the world? We have divided these models into three groups. The first one is the market development approach, the second, the compulsory approach, and the third one, the cross-border sandbox approach. The market development approach, which some regulators call the organic approach, for example, the Monetary Authority of Singapore calls it that way, basically divides jurisdiction into two subgroups. One of them is when the regulator, or those jurisdictions in which the regulator has kind of have a role of facilitator. So the regulator decides to facilitate the implementation of open finance, but is not making mandatory for financial institutions to open the access to data to third-party service providers. This is the case of the Monetary Authority of Singapore, of the Hong Kong Monetary Authority. They both regulators have decided to implement open finance or open banking frameworks, but this is not a regulatory framework. It's a voluntary framework, and the regulator is interested in being the orchestrator of the implementation. So they have incentives, and they provide incentives to all parties in the ecosystem to join the scheme and connect through open APIs. And in these jurisdictions, financial institutions, the traditional ones, kind of realize the potential of opening the access to data to third-party service providers, because they also can have this role of being a third-party service provider and have access to data that others control. So they see the advantages of this. The no intervention is the second group within the market development approach. And those jurisdictions are the ones that have decided to let the market decide what they want to do with the use of open application programming interfaces. That this is the example of the United States, of Japan, in which the regulator is not being the orchestrator of the system necessarily. So it's just depending, it depends entirely on the willingness of financial institutions to open the access to their data, or the data that they control from the data subjects. The compulsory approach is probably those type of approaches that where we started to talk about open finance, and the conversation evolved into this new term. And the conversation was originated in the European Union and the United Kingdom. In the European Union with PSD2, and in the UK with open banking, now open finance. And in this compulsory approach, regulators decide that some financial institutions, or in some of them, all financial institutions, are obliged to open their data through open APIs. In some countries, the regulator decides what type of data should be easily accessible through open APIs to third-party service provider, but it's difficult to see the same standard or the same type of regulatory framework within the group of jurisdictions that are part of the compulsory approach. Some differences that we've seen are related to the API standards that they need to follow. No, not all regulatory frameworks on open finance talk about these API standards. Sometimes it's the financial services industry that self-regulates those type of standards. The governance framework is something that not all jurisdictions are addressing. Regulation of third-party service providers is something that not all these countries or regulators are addressing either in these open finance regulatory frameworks, and the type of data that is exposed or shared through open APIs. And the cross-border sandbox are just some jurisdictions that decided to put or implement an open API platform for companies that are interested in having access to the data controlled by traditional financial institutions. And these platforms operate with companies from different countries. One of the orchestrators of this type of initiatives was the Monetary Authority of Singapore in Southeast Asia, for example, but the UK has a very similar type of initiative in Europe and in the UK. In Singapore, how is open finance working? Now it's not only about banking services, as I mentioned before, but also about capital markets, insurance, payments, and basically the entire financial services industry is being affected by open banking in a good way, because these third-party service providers are interested in having access to the data. However, we still need to address some of those challenges that I just mentioned before. For example, governance issues and the unintended consequences of specific use cases of that are developed based on this enhanced access to data ecosystem. In Singapore also, we are seeing that the regulator or the public sector has an important role in the implementation of open finance. Why? The role here is basically the Monetary Authority of Singapore decided to launch something called SGGF Index. What is SGGF Index? Is this platform or this application that is connecting traditional financial data or traditional financial institutions that hold that data with something, with the third-party developer that is called the Financial Planning App. So this is trying to mimic what the European Union tried to do with the data aggregators. So SGGF Index is basically a data aggregator. This is not to initiate payments or initiate transactions, but it's just something that will add all your data in one single repository, and the financial planning app will be able to access to your data as a financial consumer by connecting to SGGF Index. SGGF Index use open APIs to gather the data or to have access to the data that is controlled in terms of data protection regulation by traditional financial institutions or by banks. Other parties in the ecosystem are entering in this new framework, in this new initiative, not only financial institutions. So we are starting to see these type of initiatives in open finance that not only involve players from the financial system, but also other types of data controllers. For example, in Singapore, with the SGGF Index initiative, some government authorities and government data repositories are entering in the scheme. The CPF ordinary account, the special account, and these data repositories from the government that have to do with retirement plans for the population is one type of data that is being included in the SGGF Index initiative. The tax authority data is also included here. The HDB, which is data that it's about where people live and where are their homes, and this type of data is also included in SGGF Index. And HDB loan outstanding balance, so how much people need to pay in order to get their home, the home where they live, is something that is also included in SGGF Index. Basically, the financial planning app will show the financial consumer in a dashboard all their data from the financial system, if they agree to see their data in that platform or in that dashboard, with the data from the government that they also provide consent to. So the consent is basically to aggregate, is about aggregating the data in this single dashboard that will show the consumer what they have in the financial services industry and from the government data repositories. An additional layer to what a financial planning app is offering is about obviously advice type of services. And what is this advice about? For example, these banks that are offering right now financial planning apps can, based on this data, based on that dashboard, tell the financial consumer that probably this person can manage their income, their monthly income in a better way in order to have more savings at the end of the year. That's one example of the type of advice that a financial planning app could give to financial consumers. What is happening in Hong Kong? Something quite similar, and actually it is part of this approach that I was calling the facilitator type of approach. And the initiative in Hong Kong is called the Commercial Data Interchange. The Commercial Data Interchange, as it was defined by the authorities in the country, is a consent-based financial infrastructure that will enable more secure and efficient data flow between banks and sources of commercial data. So again, this is bringing different data sources, as Singapore also did, to the open finance ecosystem. So telco providers, utility providers, and not only traditional financial data is included in this type of initiatives, which is something very interesting, something that both jurisdictions probably will address in the future and will need to do so in order to tackle those challenges that we were talking about in the beginning of the presentation, is to see the unintended consequences of the secondary use of data and going beyond safeguards and protection related to giving consent in this type of ecosystem, because obviously that's an important first layer of protection, but it's not enough, because sometimes the use cases, the implementation of open finance initiatives, and we will see with fair lending, are based on aggregation of data or secondary data use, which not always calls to or needs legally, according to the data protection regimes, needs the consent of someone because it's not linked to an individual. In some cases, for example, what the algorithm produces is called in some data protection regimes, for example, in Singapore, opinion data. And based on that, the consent is not enough to protect financial consumers from the unintended consequences of the use of data. So those are important challenges that we need to address in the future, basically going beyond consent in the open finance ecosystem. And for lending, as I mentioned, is probably the use case in AI that is capturing a lot of attention in the open finance implementations, because having more access to data will mean that financial institutions and these third-party service providers will be able to have more robust data to develop this type of data-driven financial applications. And online lending and for lending and lending based on algorithms is something that is very profitable for these companies. And actually a lot of studies are looking into the benefits and the potential of using data to increase the accuracy of lending models that are based on the use of algorithms. This is something, however, that also we need to look closely because of the unintended consequences, of particularly the issues related to bias in the decision-making process of creditworthiness when an online lender or even a traditional financial institution is based the decisions to give loans to someone on an algorithm, on data, and not only financial data, but also non-traditional data or alternative data that comes in the financial system through initiatives similar to open finance. This is just a picture of an example of those unintended consequences. This was a famous case in the United States. Goldman Sachs and Apple partnered to develop an AI credit scoring model for credit cards, but on Twitter, a very influential person on the tech industry tweeted that his wife was approved by the algorithmic credit scoring, but the amount of the loan that was given to her was significantly lower than what was approved for him. And his tax records and his financial information basically shows that his wife is earning more on a yearly basis. So he wasn't understanding why the algorithmic credit scoring was or seemed to be biased against female gender. After this tweet, some other people started to complain in the CFPB, the Consumer Financial Protection Bureau in the United States, and they opened an investigation against Goldman Sachs, the financial institution in charge of complying with fair lending practices. And they had to demonstrate or show to the authority that they were not biased against a female person that was applying for a loan or for a credit card. Obviously, the company is not intentionally biased against a particular minority or a particular group within the population, but that's an unintended consequence of the use of AI in these types of scenarios. Some regulators and researchers and even private companies around the world have tried to address these challenges by enacting or publishing the AI governance principles type of guidelines. That was the first approach to AI governance that started a couple of years ago. And one of those principles calls back to fairness and preventing algorithmic bias. Some other principles that are included in those type of guidelines are transparency, explainability, keeping the human in the loop, accountability. You probably have heard of those if you are familiar with AI governance principles. However, one problem or one challenge around these AI governance principle guidelines is that they are voluntarily applicable. So in the context of these unintended consequences, for example, the case of Goldman Sachs, what happens if the fair lending laws in a specific jurisdiction, in this case in the United States, are not well equipped to respond to the challenges of those unintended consequences of the use of AI? Probably the voluntary guidelines or the self-regulatory approach to AI governance won't be enough at some point when all companies start to develop AI-driven financial applications. What is the current approach to algorithmic credit scoring? Just to summarize this big chart of the different approaches, basically the Lighttouch approach is the first one, the one that I just described, on the ethical guidelines that are voluntarily applicable in the financial services industry. The Monetary Authority of Singapore, the Hong Kong Monetary Authority, both of them have developed this type of guidelines or voluntary frameworks that are applicable in the financial services industry, but they just highlight these ethical principles that financial companies will need to comply with, but they don't necessarily go beyond these guidelines based on high level principles. Also other approaches that have been developed in the last couple of years are AI regulation and initiatives by the private sector. The initiatives by the private sector are very similar to the Lighttouch approach or the ethical guidelines published by some regulators, but the AI regulation is probably the first approach that is aiming to implement something that is more on the mandatory level for companies that are interested in deploying AI use cases. This AI regulation is the one proposed by the European Commission in the European Union. We still need to see how this debate develops in the next couple of years because it's not approved yet in Parliament. But the AI Act, as it is called, is aiming to go beyond the self-regulation or the Lighttouch approach in AI governance. Is it going to be enough? It depends, and as GDPR was in the beginning, is some of the parts that are proposed in this act are more based on having a compliance check in a company. So probably in some specific use cases, we will need to go beyond those type of regulatory requirements in practice, because it's going to be not enough to address some of these unintended consequences of the use of AI. And these are just some examples of the Lighttouch guidelines or the high-level principles published by some of the major or some of the principal regulatory authorities for the financial system in different jurisdictions: the Monetary Authority of Singapore, the Financial Services Commission, as I mentioned before, the European Banking Authority, the Hong Kong Monetary Authority, as I said, and the CFPB in the United States are the ones that have been publishing these ethical guidelines. Enforcement actions have been also part of the AI governance debate. I just mentioned one of the major cases, the Apple Card, but in Singapore, the HSBC case is one that also tried to address some of the issues related to the use of AI in the financial sector. In this particular case, HSBC developed an algorithmic credit scoring based on traditional and non-traditional data. And in this case, the consumer wanted to know the process behind the decision that was taken by HSBC, but because of data protection, currently classifies the output of some algorithms as opinion. These opinions are indeed personal data, but if the opinion is the base of the decision for entering in a contract with the other party, not always the company is obliged to disclose the decision-making process behind the algorithm. So in this case, the consumer wasn't able to know the entire process behind the decision that was made by the algorithm, but the consumer was able to see the guidelines or the policy, the AI policy in very general terms, and going back to the ethical guidelines and principles enacted by the Monetary Authority of Singapore that HSBC implemented for that specific use case. Is that enough to enhance digital self-determination in the for lending context? If you are denied by one of these AI credit scoring models. Is this response enough to feel empowered as a financial consumer and as a data subject? That's something that we want to address and we need to answer with our digital self-determination research. Just to give an example of some of the problems that some regulators have encountered when they try to approach for lending in the United States, for example, and some regulators in enforcement actions have decided to avoid these or prevent these unintended consequences in algorithmic credit scoring by saying, oh, if the problem is to be biased against someone because of their gender or their age or their education, let's put out of the model, of the AI model, these problematic variables. These problematic variables, and problematic in the sense that could cause discrimination or bias against someone. But in this empirical study that we did at the center, we show that in this paper of fair lending, we show that when you take out of the model variables such as gender or education type in this specific case, if you take out gender of this model, you have a problem called omitted variable bias, which is caused basically by the correlation between variables. So the effect of taking out gender is shown in other variables, even if you take out of the model this problematic variable. Why? Because the AI model is able to guess the gender of a person based on the data collectively and how the AI model works. So it's not necessarily enough, it's not enough in practice to take out of the model the problematic variable. That type of result in seeing it empirically, this was developed with an example of a database that we found in Kaggle, data repository with different databases. And this one was about home credit default risk with more than 10,000 observations. And what we try to say in this specific implementation, this specific research, is that this approach to control the input in the model is not enough to address the unintended consequences and empower data subjects in the context of and in the framework of digital self-determination. Some other studies talk about the importance of accuracy, and accuracy being a problem in fairness. And why is it a problem? Because if we don't have enough data, even by increasing access to data with open finance initiatives, some minority groups and people that have not been included before in the financial sector are going to have problems with these unintended consequences in the context of fair lending. Part of the solution, access to data. So open finance is a good first step, but we need to create some other conditions and develop other type of principles or guidelines that call back to the concept of digital self-determination. So we need to recognize legitimate commercial market imperatives for the commodification of some data, but also to take into account that data should be used for social good and monitor those unintended consequences. This is something that Mark mentioned before in the first part of the lecture. Secondly, data that determines the exercise of digital self-determination should not be subject to property rights. So probably we need to have a conversation on what type of data is empowering data subjects. Not all data should be the same or equivalent in terms of importance to ensure digital self-determination. And the relationships between data designated as an essential for digital self-determination must be considered are at local, community, principal, national, regional, and global levels. That is another part of the conversation that we want to promote in access to data, open finance, and fair lending process. In Hong Kong, the commercial data interchange, as I mentioned before, is doing something very interesting from or in relation to that first step of enhancing access to data, which is bringing alternative data into the financial ecosystem. but we still need to see, and we are very much looking forward to, with our research, to contribute with the conversation on enhancing digital self-determination and ensuring these principles of digital self-determination in the context of open finance and AI credit scoring. Thank you so much, and we look forward to hearing your questions. Emily, I go back to you, and the floor is yours to probably start the Q&A part of the session. Thank you so much.
Yes, thank you. Thank you, Nydia. And I want to thank Professor Findlay as well. You are actually sharing my job in reminding Nydia about the time. And I also saw that you were very, very conscientious and very generous in giving additional information by taking some of the questions already. For example, you provided additional information on the concept of information looting in addressing the issue of power imbalance, which is in itself a challenge to the DSD that you talk about today. So with the time that we have got left, I think both speakers, do you want me to read the questions to you, or you can pick and choose what you want to answer? You can see on the Q&A.
I can answer some of those that are in the box, probably because the chat, I've seen that Mark took over the chat, so probably those are addressed.
Yeah, or the
exactly in the Q&A box. So Vincent is asking that whether we agree on the approach that China is taking, and to classify that approach on market development or compulsory approach. I would say it's market development mostly, but the evolution of the financial data ecosystem and data-driven finance in China is quite particular because of the non-traditional players taking over the financial system in different contexts, for example, digital payments. And these companies, Alibaba and their affiliates, are most of them used, and they have very they are very familiar with the use of open APIs, and this is a big part of their infrastructure as tech companies. So that's why the evolution of the conversation was quite different, because these players, these new players, are very important in the evolution of digital payments, and they enter right now in other spheres or in other spaces in the financial services industry. It's not the same type of evolution that we've seen in the European Union and the UK, the two models, the two most important models in the mandatory approach, in which the regulators are trying to basically increase competition, but by allowing or facilitating the entrance of the non-traditional actors. So I would classify China as the market development approach, but the difference between the two approaches makes sense because of the differences of the ecosystem in both jurisdictions. And that's another big conclusion on our research on open finance, is that we are not advocating necessarily for one model or the other. It would depend on the specific particularities of particulars of a jurisdiction. For example, in Singapore, the voluntary approach created the largest open API ecosystem, open API platform, and this registry is led by the Monetary Authority of Singapore, with almost 1,000 open APIs available for third-party service providers, is the largest around the world. And one of the banks in Singapore has the largest open API marketplace, which is DBS. They have more than 150 open APIs available for third-party service provider. This is something interesting to see in a jurisdiction that follows a voluntary approach and not a mandatory approach as the European Union. But it doesn't mean that the voluntary approach is better than the others. It would depend on the specific jurisdiction, because if traditional financial institutions are really not interested in open the access to their data, probably those jurisdictions will need a more mandatory approach instead of the voluntary one. But just to answer the question, I will classify China as the market development approach. Other people are asking about SGGF Index. How does SGGF Index ensure that all the data in the APIs is adequately protected? That's a very interesting question that actually links back to the issues on data governance and data privacy. And what SGGF Index is not is not ensuring that necessarily. That's why the Authority for Data Protection in Singapore and the Monetary Authority of Singapore have this role of regulating, the first one, the Data Protection Authority, to just enforce data protection rules for all people that are data controllers or companies that are data controllers. And in this case, the recipient of data and the originator or the company that opened their access to data, both of them remain data controllers. So both of them have duties in relation to data protection and data privacy and data governance. And additionally, the Monetary Authority of Singapore plays the role of regulating the third-party service providers. So the financial planning apps are regulated to some extent, depending on the specific company that is offering this type of services, is regulated in Singapore. However, if the company is just handling data and not monies of the consumer, is not yet licensed by the Monetary Authority of Singapore. So they will have different standards, but not necessarily SGF Index is ensuring that all the data in the APIs is adequately protected. It's more the role of the enforcement authorities in the ecosystem. In the SGGF Indexes example, you mentioned centrally managed online consent system, and in CDI example, centralized data sharing platform. Of both these instruments, products of regulatory intervention mandated or developed at the industry's own initiative voluntarily. That's a very important question, because also in our paper on digital self-determination, we talk about the importance of bringing all actors into the conversation and how to protect and how to enhance digital self-determination. And civil society is very important, but also the players, the providers of services in the ecosystem, and the ones that will be controlling the data. In both cases, the private sector was involved in these conversations, but probably we still need to see more involvement on the other side. The data subject is still not necessarily in these conversations, but both approaches in Hong Kong, in Singapore, had some type of involvement with the financial services industry and the third-party developers that were expected to join the conversation on SGF Index and CDI and these type of initiatives. Also, in terms of fair lending and the unintended consequences of the use of AI, in Singapore, something very interesting is the Veritas Initiative, an initiative by the Monetary Authority of Singapore that also, on a voluntary approach, tries to provide some metrics for financial institutions to address and to measure the impact of the use of AI in terms of discrimination, particularly credit scoring, in credit scoring AI applications. And these metrics were developed with banks, the Monetary Authority of Singapore, and technology companies, the three of them. Financial consumers were not involved in this debate and in this conversation, but that is something that we also are proposing in the digital self-determination research.
Can I jump
probably,
in?
Mark,
I'm going to shut up the last question in that chat line, and that is the light touch approach adequate in these situations? I might just say to you that digital self-determination is not really a light touch approach. What digital self-determination does is it redirects the focus to the data subject rather than the data owner. And so it tries to shift the discussion away from what is the commodity aspect of data, what do I need to protect because the data has some monetary or market value to me, and to return it to the original source of the data. Now, why would people want to do that? Why would any commercial operation want to be involved in something like that? Very simply this, that the pressure now is not so much coming from states and regional authorities to protect data, but it's to access data. And there are very few programs or strategies out there that have a balanced and measurable and, let's say, interactive approach to data access. And so if we want to move from a world where we were primarily concerned with data protection into a world where we're interested in responsible data use, then the only way to do that is to agree that there has to be, if you like, some level of consensus between data users and data subjects. And if that consensus can grow in what we refer to as safe data spaces, which might be, as one of the questions asked in the chat provoked, might be necessarily regulated by external administrations to create that space. Within that space, the possibility for consensus is there. And so it's a simple pragmatic issue, not so much light touch, but rather a move away from the idea of protecting data rights to respecting data access in responsible situations.
Thank you very much.
Emily, go ahead. I was going to open the floor for you.
Nydia, I will give you that last chance to conclude before I end the session. I hate to end it, but I try to respect everyone's time.
Thank you so much, Emily. We are very grateful for the invitation to be here, and we want to keep the conversation going. So please feel free to follow our research. Here you have our SSRN page and most of the relevant papers that we have been working on within these digital self-determination, data governance, and open finance for lending type of issues. So we look forward to hearing from you in the future. And as Emily said, we could be talking about this for hours, but unfortunately, in the interest of time and to respect what was scheduled previously, we have to end here. But we look forward to keep the conversation going in other spaces.
Thank you.
So much.